Okay, I see that Travis Smith is on, and as is Zach. Thank you. And thank you all for being here. This is our left field investors deal webinar with Zach Haptonstall from Rise 48. And we are also going to do a Tribe Best Open Tribe with this deal. So I'm going to turn it over to Travis to start out, and then we'll go right to Zach. Travis, are you on?
Yep, but I was on mute. Thank you, Jim. Good to be here. Happy Friday. Happy Friday. Yeah, really excited about this deal. Most excited about this deal this week. And, just really excited about our open tribes that we've worked hard with left field investors to build a turnkey tribe. So you can participate, and TribeVest does all the heavy lifting, right? We manage the commit form from the members. We manage all the pulling of the capital. Really, if you guys know Eric Ward, who's in a lot of tribes, and you might be in tribes with him, he'll be the manager of the tribe, and pulling the capital, getting the wire over to Rise 48, and then managing all the communications. And then this also, we handle the K1s. So everything from the beginning to the end, it really is an open tribe built around this deal, this single deal. And when you join, we just make it that easy. So anyway, really excited about the work that, again, we've done here with LFI, and to be able to offer this service. Of course, tribe vesting and group investing has always been a part of left field investors. And this is really a cool, exciting next evolution for the community and tribe vesting.
Excellent. Thank you, Travis. And just to let people know, for the tribe, the individual tribe member minimum is going to be $10,000, and the tribe capital minimum threshold, which means the amount we need in the tribe to open and have the tribe operate, is $100,000. So with these deals, you can invest through the tribe, or you can invest directly through Rise 48. And either way, if we get to the 500,000 in the tribe, and or with the separate investments, if we get to that 500,000, we'll get those enhanced terms that Zach is going to talk about. And I will introduce Zach now, and I'm gonna kind of put you in a tough spot, Zach, because I'm gonna ask you a tough question right out of the gates. But this is Zach Haptonstall from Rise 48. And I do want to say one thing before I put Zach on the spot. March 2nd, we are going to have a meetup with Rise 48 and Impact Equity in Phoenix. And it's just going to be a 2-hour cocktail party. Richard Wilson from the Family Office Club will be there. Zach will be there. Randy Smith will be there, and I will be there. So we're really excited about that. I sent out an email, I think today, so please RSVP so we can kind of get a head count on that if you're in the Phoenix area. With that, I do want to introduce this deal. It's the first deal that they've done in Dallas. And Zach, we've had conversations, and we're a very risk averse group, although we're investors. And we say often that we don't want to be anybody's guinea pig. So right. This is the first Dallas deal. And I know you've put some things in place, so you're not just willy-nilly reaching out in Dallas. And if it's part of the presentation, we can wait. But one of the top questions we're going to have is, why should we jump into this new venture with you? So whether you address it now or later, we just want to hear it. And I know you have good answers for it.
Yeah, no, absolutely, Jim. Yeah. And we agree 100%. I mean, we don't want anybody to be our guinea pig, and we don't want to expand without having infrastructure in place. And so, yeah, we actually do have new slides that we've created specifically for this deck, just to show investors the infrastructure that we have been working on and the full staff that we've already hired. We already opened up an office there. I actually just bought a house out in Dallas. My wife and I bought a second home in Dallas. I was just there this week for a few days, and we'll be there every 2 weeks going forward. So yeah, it's a great question, obviously. And the truth is that I, as an individual, am the single biggest investor in our deals. Okay. So I have 100% of my net worth in our deals. I invest more money personally than any other investor we've ever had. And so, I don't want my own money to fail. So yeah, so we'll go into that. It's a great question. Obviously very relevant. Yeah. And it's really in the beginning of the slides here, but, thanks everybody for taking the time, and everybody's busy. And thank you, Jim with LFI, of course, and then Travis with TribeVest. I know, Travis and I were talking in November, and we're really excited to become, preferred partner on your new platform with TribeVest. And so, with that said, we'll jump right into it. And, I do have a hard stop at like 10 to 15 minutes after this next hour. So about an hour. So I'll try to get through this in like 50, 55 minutes and then get through Q&A. And then, any other questions after that, of course, I'm available to get on a call, emails, if we wanted to get on a second Q&A, Zoom, whatever, but we'll try to get through this. But yeah, so this is our first deal in the Dallas market. We're really excited about this. It's a 328 unit value add deal. This is the first deal we've ever purchased from a truly distressed seller. Okay. And I'll go into that here a little bit more, but basically the seller did not execute their business plan. They put a 3-year bridge loan on this deal in March of 2020. And that bridge loan has a balloon payment in 2 months, okay, in March of 2023. They had very high offers last year that they didn't take. One buyer fell out of contract. I'll go into details. They tried to refi in the fourth quarter to take out the bridge loan. They were not able to do it because they didn't increase their NOI. And so we're getting the deal at a very low cost basis, and really excited about the deal. So I'll jump into that here shortly. But first we'll go over our disclaimer. This is a 506B offering. So this investment is not available to the public. You won't see it on any social media or any websites, anything like that. And so this is an exclusive offering we have with the LFI group to do this Class C structure. Here's the agenda for the presentation. We'll go over the sponsorship team, which will really include our Dallas infrastructure, executive summary of the business plan, the highlights of the investment. We'll talk about the asset itself, Rise at Highland Meadows. We'll take you through the key underwriting assumptions and the financial analysis. We'll talk about the macro components of this Dallas MSA, which we've spent a ton of time researching and really have a good holding on it. And then we'll talk about the micro components of this submarket. We'll go through our comprehensive market survey where we personally secret shop the comps. I personally secret shop the comps. So I went to every single property in this comp set and met with the manager, toured the assets. We have a good idea of what the comps in the immediate area are. We'll take you through the acquisition timeline and some of the key deadlines. Then we'll go through a Q&A session. And so, sponsorship team, everybody's kind of aware, or most people are, who've invested with us of Rise 48 is Bikram Sandhu, our CFO, Robert Shefchik, and then myself. We also partner with Ryan McKenna as a co-GP on most of our deals. And, here, let's jump into your question, Jim, because that's obviously the biggest thing is like, okay, Rise 48 has been successful in the Phoenix market, and we're local to Phoenix, but, nobody wants to be a guinea pig, like you said, Jim. And so, why would we invest with a new operator in a new market? And so the truth is that we've had the equity demand to expand to a new market for over 2 years. Okay. We've had investors asking. I have several investors who have invested in literally 10 to 15 deals with us. And they say, hey, we like investing with you guys. We like the reporting, the performance. We don't want so much money in one market. We want diversification. Okay. But we've been waiting to truly build out our infrastructure, our supply chain, and all of our systems and processes so that we feel confident that, once we're just really solid in Phoenix, we can translate that to a new market. Okay. And now we feel like we're at that point. And so in the beginning of 2022, the plan was to open up a new market in 2023. Okay. So about 12 months ago, we were planning on going to Vegas, Las Vegas in 2023. But, second quarter into the summer, once, interest rates started going up and we see this recession coming, we said, we don't want to touch Vegas. Okay. We don't trust it. We don't trust the employment diversification or lack thereof. And so we said, you know what, we want to stay Western US. And we really think, the best markets in the country are Phoenix, Dallas, some of those Florida markets, the Carolinas are obviously very strong. But for our first market, we don't want to be too far away. Okay. So this is about a two-hour flight there, 2.5 hours back, Phoenix to Dallas. So we can get there very quickly. I've been there now 5 times since the end of November. And so, what we did is before we even had a deal, we said we need to hire out infrastructure. So here you see our Dallas leadership team. So we've hired Barbara Moffitt as our regional vice president. She's local to Dallas, has lived there for 20 plus years and has worked for over 20 years specifically in workforce housing, multifamily. Okay, so she's really going to lead the property management efforts. We're going to have the exact same platform in Dallas that we have in Phoenix. We're going to be vertically integrated day one with property management in-house, construction management in-house, same exact supply chain, which we'll go into. So Barbara will lead the property management efforts. We've hired Chrissy Freud as our regional property director. You know, she has a ton of experience as a regional for property management companies of specifically workforce housing, multifamily. So really excited to have her on. Tim Gibbs, our asset manager, you know, has over 20 years of construction experience in the Dallas market, born and raised in Dallas, over 10 years just doing renovation projects like this. And then no pun intended here, but Dallas Martinez, the individual, has been our construction manager in Phoenix for over a year. Okay. And when we said we're expanding to Dallas, he said, I want to transfer. Okay. Because he has family in Dallas. So he literally just moved his wife and 3 kids to the city of Dallas and is now permanently there. And he's going to run the construction management. And so we have a ton of confidence in him and we know that he can execute. We built out so much infrastructure in Phoenix that his right-hand man in Phoenix has moved into that role in Phoenix, and Dallas is going to spearhead our construction management. And so, you know, this is our leadership team out of the gates here that we feel really strong about. We've already hired 12 full-time people that have already started in the Dallas market. Okay. But these are all 6-figure salaried W-2 employees you see right here, and really kind of the foundation. As we start adding more assets, we'll start to build out that tree to have our staffing ratios in line. So here you kind of see our leadership staff. All these people have been hired, full-time W-2 salary on full benefits. Let's talk about infrastructure. Okay. So, you know, we want to make sure we have infrastructure. We're vertically integrated. We don't want to be one of those sponsors that not only, you know, doesn't live in the market and doesn't have a local presence, but doesn't have staff. And so we said, we need to establish this beforehand. So we opened up a 9,000 square foot office in downtown Dallas in December, in the Chase Tower. I was just there this week. And, you know, like I said, my wife and I just purchased a second home in Dallas, in the East Dallas area. It's literally 5 to 10 minutes away from this property. And so, you know, we'll be there. Most people don't realize my wife, Grace, works full-time in the business as our VP of marketing. Bikron's wife, Alice, works full-time in the business as our VP of investor relations. Bikron and I will be in Dallas bi-weekly going forward. Okay. So every 2 weeks, we'll be there for a few days to do our bi-weekly operations meetings with our local staff. We do the same thing in Phoenix, where we sit down with all our regionals, our asset management team, the marketing director, and we go through key metrics for every single asset every 2 weeks to make sure things are staying on track and renovation schedules are staying on track. So we'll have the exact same process that we do in Phoenix, and we'll apply that to Dallas. You can see here, you know, some photos on the right of our office in downtown Dallas in the Chase Tower there. Like I mentioned, we'll be there, you know, bi-weekly. So probably spend about 6 to 8 business days a month in the Dallas market. And again, you know, for those of you who are like, well, I've invested in Phoenix deals, you're not going to forget about Phoenix, right? And the answer is no. We love Phoenix. We're still very bullish and confident in Phoenix. You know, the plan this year is to really have an equal balance of Phoenix and Dallas deals, okay, to provide diversification to our investors. And so, you know, our centralized corporate office will still be in Phoenix, in the Scottsdale area. This is where I am right now. So we've got like 40, 50 people here right now, as we do every day. So, you know, accounting, investor relations will remain centralized here at the Phoenix office. Okay. So for those of you who have invested with us before, all of your investor reporting will look the exact same format, same individuals doing it. You know, the whole process for intake, for reviewing your documents on the front end, confirming your wiring instructions, confirming your wire was received, all that will remain the same. We're just building out local staff in the Dallas office for what we need in that new market. And then here you see consistent supply chain. Okay. And so we have, for those of you who don't know, you know, something that's really given us an operational advantage in Phoenix is that we control our supply chain 100%. Okay. So we buy all of our materials for the interior renovations directly wholesale from overseas manufacturers. Okay. Our manufacturers have plants in Taiwan, Malaysia, Vietnam, and Shanghai. And so every single thing inside the interior unit, with the exception of the adhesive for the vinyl plank flooring and the appliances, we buy directly wholesale that they manufacture. And then they source those other 2 items for us, but they manufacture it. They ship it overseas to their warehouse in Phoenix, and they hold it for us. They build custom kits and then deliver them in the unit on site with everything that's been custom measured for that unit. So our construction guys go in there, crank through everything. Okay. So we've had a very efficient process. Our supplier has 2 warehouses in the United States. One is in Phoenix, and they have a 70,000 square foot warehouse in Dallas. Okay, this is why we felt so confident expanding to this market, is because we have the exact same supply chain in Dallas that we have in Phoenix. The same contacts. I was out there in early December at the warehouse, meeting with the staff along with our team. It's the same person, we're working directly with the owner of the company, and we have the same fixed cost. Okay. So right now in Phoenix, we're renovating about 70 to 100 units a month, very seamlessly. We will have the exact same interior scope, same materials, and everything will be the same. So this gives us a lot of confidence. And I've toured at least 30 to 40 different apartments, 1980s vintage in the Dallas market since November. And everything is almost the same as Phoenix. Okay. Most of the competition in Dallas is doing what Phoenix competition is doing, where they're just resurfacing countertops, they're painting original cabinets, putting in black appliances. They're doing lipstick on a pig type of renovation, which is what we did, 3 years ago or so, because we couldn't afford to do a higher level scope. But once we started to gain that wholesale buying power and get our costs down, we could do this high-end scope with the quartz countertops, undermount sinks, stainless steel appliances, brand new cabinets, et cetera. And we'll go into that here shortly. But anyways, we've realized that we'll have the same advantage in the Dallas market. We're going to have a higher scope than almost everybody, but it's still going to be an affordable rent, which really allows us to push the rents a little bit more, gives us that insulation. So, as you can see here with this graphic, kind of shows you our entire process for how that works. And then here you see kind of an org chart, how we'll be vertically integrated in the Dallas market. So we've got the equity company, Rise 48 Communities is our property management company. So we'll do all that in-house. Rise 48 Construction is our construction company. So we'll do all that in-house. And so as you can see, we have over 170 staff in Phoenix. We've already hired 12 full-time people in the Dallas office. So we already have an office manager, an IT coordinator. We have a marketing coordinator. I just interviewed an HR generalist and hired them. And so, we've got all this staff and infrastructure already built out. We showed you kind of our key operations people that will be in the field. And then of course we'll have on-site staff as well. And so as you can see here, it's going to be a very similar platform. And, we've really mitigated a lot of risk because we've taken a few years to make sure that our supply chain and our processes in the back office and everything are really ironed out. Okay. Because this is not just so people know, this is not like an experiment. Okay. We're not like dipping our toes in Dallas. We plan to be in Dallas for the next 10 to 20 years, at least. And I think we'll probably be a top 5 buyer in Dallas this year. Okay. So what happened, and as far as deal sourcing, is that, as many of you may know, in Phoenix, we're the top buyer in Arizona the last year. I think we're like the number 3 the last 5 years. We bought over $1.5 billion worth of assets. There's like 5 to 7 individual brokers who control the market in Phoenix. Okay. They control like 90% of the inventory. And I called all of them in November, said, hey, can you introduce me to your top guys in Dallas? And it's the same exact brokerage firms. It's CBRE, Marcus & Millichap, JLL, Berkadia, Northmark, Newmark. So they're like, yeah, we'll refer you. We have a good relationship. So, we get referred and endorsed to all the top brokers. And we met with all the top, there's like 7 or 8 top guys in Dallas, met them in November before Thanksgiving, all in person. And we were really surprised and humbled that they had already heard about us. Okay. We had a lot of credibility, and we're getting fed off-market deals every single week since then. Okay. So we feel like we have a big advantage with the broker relationships because, these broker firms are national firms, and all these guys seem to know each other in the big markets because they go to their annual retreats, all that stuff. And so we have a really good advantage as far as sourcing deals. And I'll kind of go into that, here shortly for this deal. Here you see a track record. So since we started, we've gone full cycle, successfully executed the business plan and sold 11 different properties. We've never done a capital call, never even come close. I know that, some of you may have heard there are sponsors doing capital calls across the country right now. Okay. Because interest rates have gone up significantly. We have no concerns of doing capital calls on any asset. We're doing monthly stress tests across the portfolio, assuming the max interest rate for the next 36 months. And we're assuming that NOI shrinks significantly. And the purpose of those stress tests is to see, do we run out of cash in any asset? And on all these stress tests every single month, we don't run out of cash on any asset. We don't have to do any capital calls. We have no concerns of doing capital calls for at least the next 3 to 5 years or at all, So, that's very important. And we want people to know that. We've distributed over $58 million to date. We do monthly investor reporting, monthly distribution. So the same exact schedule, same investor reporting and format for the Dallas market. Here you see our portfolio. Like we said, we purchased 38 assets in Phoenix, over 1.5 billion, over 6,500 units. Almost all of this is 1980s product, just like this Dallas asset, same exact vintage, same business plan, same interior scope. Here you see a summary of the track record. And so This is the 11 deals that we've sold. In the light blue, you see the projected returns on the front end before we purchased the deal. So just like in this investment opportunity today, we'll show you the projected returns. We always project a 5-year conservative hold. Okay. And across these 11, we were projecting a 1.9 equity multiple. So meaning you invest 100K, we give you 100K back plus 90K of profit over 5 years. We're projecting just over a 15% internal rate of return, or IRR. In the dark blue, you see actual performance. In reality, we've sold these 11 deals on average in just under 18 months. We've more than doubled investor money, and it's been a little bit over a 70% IRR. Okay, that's actual performance. We've done 1031 exchanges on 7 of these 11 deals, and the goal is to 1031 exchange everything going forward. And many of you are probably saying, well, yeah, the market's been strong, right? You guys, the market can make anybody look smart, right? And we've been huge benefactors of that, no doubt. But if you look at these returns compared to most of the sponsors that we've seen, these surpass those returns in the same period that we were competing against other sponsors. And the difference for us, which we'll go into shortly, is that we truly add value. We can truly execute a business plan by renovating interiors on schedule, on budget, provide a higher level scope to force the appreciation, not just rely on organic appreciation. I've been telling investors the last 6 months that historically we've been doubling investor money, in about 18 months on average. Don't expect that anymore. Okay. It's going to take us at least 2 to 3 years, 3 to 4 years to hit the same returns that we were hitting in about 12 to 18 months. And that's primarily for 2 reasons. One, interest rates have gone up significantly in a short amount of time. They've gone up faster than any point in time in this short amount of time since the 1980s. Okay. So we haven't seen this drastic of an increase in a short amount of time since the 80s, over 40 years. So your debt is more expensive, and organic rent growth has started to decelerate and normalize across the country. Okay. So for those 2 reasons, it just takes a little bit longer to hit your target exit valuation, to hit your target investor return. But, even if we can double investor money in 3 or 4 years, that's still a really strong return. Hard to find that anywhere else. And it's always a 5-year projection. Okay. So that would still drastically exceed. So even right now, deals we bought in 2021, 2022, we still feel very confident we'll meet or exceed our 5-year projection on those deals because we're still having no issues increasing the rents above pro forma. All right, let's jump into the executive summary for this deal. So this deal is currently called Paces Cove Apartments. It's 328 units. It's a 1983 build. It's in a great northeast submarket of Dallas. Again, I bought a house recently in Lake Highlands, about 5-10 minutes away from this location. So, I'll be checking on the staff there pretty frequently every time I'm in town and just stop by. And we're going to rebrand it to Rise at Highland Meadows. And so the story on this deal is that the sellers, they basically put a new loan on it in 2020, a 3-year bridge loan in March of 2020. The plan was to renovate all the units, increase the NOI, and increase the value. Well, the market was really strong in the second half of 2020, 2021. They did not execute their business plan at all. They did not renovate any of the interiors. They were just kind of banking on that organic appreciation. And in the beginning of 2022, they had a broker valuation at $49 million sales price. Okay. They said, hey, we can get $49 million for this. They got an offer around the same time at $48.5 million. They turned their nose up at the offer, said, no, we can get at least 49 or more. We don't want it. Well, then all of a sudden interest rates start going up in March and values start to come down, right? Because buyers have less purchasing power with higher debt. So in May, they finally go under contract at $44 million. Okay. During the summer, the buyer, his loan blows up because of interest rates. He falls out of contract, loses his earnest money. So now they don't have a buyer. They can't find a buyer at a price that they want because they were set on that $49 million price. In the fourth quarter of 2022, so just a few months ago, they tried to refinance the loan into like a 10-year Freddie Mac loan to take out the bridge loan before their balloon payment comes up. Well, they didn't execute their plan, didn't push the appreciation of the NOI enough to qualify for more loan proceeds to take out the bridge loan. So they couldn't even refi. So they're like, oh crap, we have a balloon payment coming up in March. And so we went and toured this deal it was the week, I think it was a week after Thanksgiving. We went and toured the deal, and the brokerage firm is called Northmark. I'm friends with the national president of that firm. Okay. He's a good friend of mine here in Phoenix. We bought 7 deals from them last year, mostly off market. So he tells the guys that report to him in Dallas, he's their boss, he's the national boss. He says, hey, hook these guys up. They can close. So we go tour the deal. And I asked the local broker, I said, what's the price? Like these guys are obviously in trouble. He told me the story. What do they need? He said 39 million done deal. Okay. And we could get to 40 million in our model. We made 40 million pencil, but we offered 39 million. He went back and like wanted 50,000 more, and we got the deal. Okay. So for 39 million, 50,000. So almost a 20% discount from what it was valued at about 12 months ago, 119K a door, really good basis because they're distressed. Okay. So as you can see here, it's got an ideal unit mix for this location. There's a lot of strong jobs nearby, a lot of young professionals with higher incomes. You've got 82% one bedrooms, 18% two bedrooms. So these are affordable rents and really fits that local demographic. You've got pretty large units at 670 square feet, for these one bedrooms. And then it's a large asset. There's a full amenity package, leasing office, clubhouse, 2 pools, fitness center, et cetera. And so the business plan really centers around renovating 100% of these classic units to our interior scope, our platinum level scope, to push those rents. And there's also significant loss to lease in place where they have not been pushing up the rents relative to what you can get for an unrenovated unit. And so there's a lot of upside in this deal. And again, this is truly the first distressed deal that we've bought since we started the company. Here you see purchase price just over 39 million. We're raising about $25 million of equity, over 96% occupancy, 2 to 5 year projected hold period, $50,000 minimum investment. Let's talk about the location. So like we said, this is a really good Northeast Dallas submarket. It's a B-class asset, B location. You've got SMU, Southern Methodist University, less than 15 minutes away, over 2,800 employees. You have the ACOM headquarters and the Texas Instrument national headquarters within 12 minutes. Both have over 10,000 employees. And you've got major freeway systems surrounding the assets. You can really get to different parts of the DFW market pretty quickly and get to major employment hubs. Like we said, we'll renovate 100% of these 328 units to our platinum level scope. And again, it's just like Phoenix. I'm telling you that our scope is much higher level than almost all of the competition for 1980s vintage. And talking to different brokers, property management companies, we asked them in November when we were trying to do our market research, if you have a higher level scope, can you command a higher rent? And they all said yes. Like, but people will pay more for a higher level scope because they like the interiors. So our scope is brand new vinyl plank flooring, a real quartz countertop with undermount sinks, modern plumbing pull down fixtures, subway tile backsplash, stainless steel appliances, brand new cabinet boxes with shaker doors and brushed nickel hardware, 2-tone paint, LED lighting package, and new baseboard. Okay, so it's a full interior scope. And by the time we're done, it will look like a Class A luxury interior finish, but it's in a workforce housing type of product, which is still affordable and where the majority of the population lives. That will allow us to drastically increase the rents without having to rely on organic appreciation, because we're forcing the appreciation by providing a higher quality product. When we increase those rents, it'll increase the value of the asset and get that profit margin for you, the investor. So that's the interior scope. Like we talked about, there's operational upside. They did a recapitalization with an equity partner 3 years ago and put a new bridge loan on. But this sponsor has owned the deal since 2014. Okay, so they bought it at a very low basis. They had I think they were like a syndication group, they had a different equity source. They recapitalized them out in 2020 with a JV equity group, put this 3-year bridge loan on it, didn't renovate anything. And so because they bought it so long ago, their basis is low. And so, they're probably making pretty good cash flow, and we're not trying to push the rent. So there is a lot of loss to lease in place, which we'll go over here shortly. We'll show you kind of the breakdown of our total rental increase as it relates to loss to lease versus value add upside. And like we always do, we flew 12 of our own full-time staff out here to do the due diligence, okay, in the beginning, first week of December. So we performed a full DD. We also had multiple subcontractors out there, okay? So our regional vice president, Barbara, has a ton of contacts. And so we had like seven or eight different construction companies out there. We had multiple roofers, plumbers, electricians, everything. And so we're really dialed into all the local vendors there because of the people that we've hired and who have been working with these companies for several years. And so the asset is very clean, no major deferred maintenance, really well taken care of. It's just they haven't renovated the interiors. Here you see some facts in the Dallas market. And so US Census Bureau said that from 2020 to 2021, the Dallas-Fort Worth Metro was #1 in population growth. It's now the 9th most populous city in the United States. As many of you know from our other decks, Phoenix is #5. And so that's why we like Phoenix and Dallas, because they have strong population growth, strong job growth. You see RealPage as of November is saying that the organic rent growth trailing 12 is 8.5% in Dallas. So very strong. Yardi is saying 8.6%. And, similar to Phoenix, almost the exact same median sales price, okay, of a single family home. So median sales price of a single family home, according to realtor.com economics, $440,000. The reality is that the majority of this demographic cannot afford to buy a home, especially with interest rates so high. They don't qualify to meet the debt to income ratio. So they're going to want to rent an affordable, high quality interior unit like this one. So it really pushes a lot of those people into renting, which benefits us as investors in these deals. Here you see the strong job growth. DFW was number 2 in the country last year, according to U.S. Bureau of Labor Statistics for job growth, which was over 242,000 new jobs. Here you see kind of just a little map, an area highlight. We always provide our Phoenix, our Phoenix map and the Phoenix deals. So we want to provide, a Dallas deal. And so, my house is right over here, Lake Highlands area. This is the asset. This is our corporate office downtown. Okay. So it's about 15 to 20 minutes away from the office. So we can get there very quickly. And we're really going to try to focus on buying deals in this infill Dallas area going forward. And so if you look over here in the upper right-hand corner, you've got the submarket statistics from RealPage for this, what they call the Far East Dallas submarket. And, one thing to focus on is the supply versus demand forecast for new multifamily units. Okay. The reason we want to be in infill Dallas, because just like Phoenix, there's hardly any land right here to be building new apartments. Okay. It's all landlocked. Everything is already accounted for. This is not like tertiary market. This is true Metro Dallas. It has a Dallas zip code. And so as you can see here in the next 12 months, there's only 37 new units forecasted to come online. And the demand just in this immediate submarket is 148. So whenever you have a lot more demand than supply, that benefits us because it leads to high occupancy. Right now the asset is almost 97% occupied. They're forecasting almost 95% for that submarket the next 12 months. And then trailing 12 rent growth in the submarket is 15.3%. Okay. So RealPage is saying that the entire Dallas MSA is 8.5%, but they're saying that for this particular area, 15.3%. Okay. So it's a really strong submarket. And we feel really good about it in this location. Okay. Here you see the investment options. So obviously this is our main deck for all of our investors. This is a special LFI webinar we're doing. And so really disregard the Class B. For the purposes of this presentation, you can focus on Class A or Class C. Okay. So Class A is a $50,000 minimum investment, which is really the higher immediate cash flow, but you do not participate in upside. Okay. So you're going to get 10% cash flow on your money right out of the gates. So if you invest 100K, you can expect to get $10,000 a year paid out in equal monthly installments, but you will not participate in upside. So when we sell the deal, you'll get your initial investment back and that's it. Okay. You've made that higher yield throughout the investment period. And then we have Class C available for LFI investors. Class C is a 50K minimum. Okay. For individuals in LFI. And, like Jim said, if the group collectively, between Tribe Vest and LFI gets over 500K at least, everybody will get the Class C. We're very confident that will happen. We've carved out, a little over $1 million for LFI investors. I have to check. I think they carved out like 1.5. And Jim and I were talking recently about what the past performance has been. And so we're very confident LFI will hit that number so that individuals will get the Class C. You get an 8% preferred cash on cash, which means that it's a 100-0 split between the passive investor and us, the sponsor, until your preferred return is caught up. Okay. So 100% of cash flow, 100% of equity goes to passive investors. We, the sponsor, receive 0 cash flow, 0 equity until your preferred return is caught up. Once your preferred return is caught up, it's an 80-20 split. Okay. So 80% to you, the passive investor, 20% to us. And unlike our Class B, which is most of our investors, there's no second hurdle over a 2x multiple. So anything over a 2x multiple, it's just 80-20 regardless of the upside. We always tell investors that we as a sponsor, we're really not going to receive any cash flow or quote unquote sweat equity until we've actually executed the business plan and achieved a capital event like a sale or a refinance. At that point, we can fully catch you up on your preferred return. Then after we catch you up on that preferred return, we split 80-20. So you've got this preferential Class C structure for LFI investors in this deal. You can disregard that. And then here, this kind of shows the return summaries for Class A and Class C. So here in the lower left-hand corner, so you can see you're really getting a 10% stronger return. And, if anything over 2x, this actually could get significantly higher. Okay. This is not really considering going over that hurdle. And so, for a Class C investor for LFI, we're projecting 6.1% average cash flow over the 5 years, a 2.11 equity multiple over the 5 years, 17% internal rate of return, and a 22.3% average annual return. You can see how that kind of compares to our Class B. And then obviously you have the Class A there. So again, this is a very conservative projection over 5 years. In reality, we've drastically exceeded that in less than half the time. We still think it's very likely that we could exceed this, not like I said earlier, not in 18 months, that's not realistic anymore with their markets at, but we think this is a conservative projection. Here you see kind of the cash flow breakdown years 1 through 5. And I won't spend too much time on this because I know everybody will have the deck from Jim, but you kind of see how that works. Let's go through the rent growth projections for the Dallas market. We really want to show you historical rent growth, future projected rent growth, and then what our assumptions are for this deal. So you can see just how conservative it is, okay? And we've really dug into this market, okay? So between Bikram, our CFO, and Brady, acquisitions manager, no exaggeration, these guys have underwritten probably at least 40 to 50 deals already, okay? Most of them don't work. That's just how it works. It's how Phoenix is too. It's a volume game. But we're very dialed in by talking to all the different lenders in the market, debt brokers, insurance consultants, everything about our assumptions. So I'll start here on the right-hand side. The 10-year historical year-over-year rent growth in Dallas is 5.6% year-over-year on average, okay? Trailing 12 inflation, this is a little outdated. Inflation numbers just came in yesterday, went down a little bit, which is good. But as of November, it was 7.1%. Trailing 12 Dallas inflation before yesterday was 8.4%, so higher than the US average. Like we said, trailing 12 rent growth in Dallas the last 12 months is 8.5% according to RealPage, 8.6% according to Yardi. RealPage is projecting forward-looking the next 4 years, and that's as far as they go out, that year-over-year average rent growth will be 4.1%, okay? In this model, we're assuming 0% rent growth in year 1. Okay, this is the first time that we've done this since 2020 with COVID. Okay, we just did a Phoenix deal about 4 weeks ago. We assumed 0% rent growth in year 1 as well, and that's because we're obviously, depending who you ask, I think we've been in a recession, but we're going into a recession, and so we're not assuming any organic rent growth in year 1. The projections that we're showing you for returns are assuming 0% organic in year 1. We have a 3% year-over-year organic rent growth over the 5 years. So very conservative. So you can see here our forward-looking projections. The orange dotted line is RealPage at 4.1%. We're assuming only 3%. So well below what they're projecting. Here you see the same data laid out in a different format. You have trailing 12 organic rent growth, 8.6%, US inflation. This is the last 10 years, year over year has been 5.6%. So these 3 numbers on the left are backward looking, trailing 12, and this is the last 10 years. These 4 items on the right are forward looking. Okay. So future projections. RealPage, like we said, is projecting 4.1% organic rent growth the next 4 years. CoStar is projecting 5.2% the next few years. We're projecting 0% rent growth in year 1, and we're projecting only 3% the next 5 years on average. So we're below both CoStar and RealPage's projections for forward-looking projections. So we just want to show you that, one of the major reasons we've been successful in Phoenix is because we truly have conservative assumptions for both organic rent growth, which was showcased here, and what our pro forma rents are, which we'll go over here soon. And that's why, we're not trying to reinvent the wheel and have these crazy aggressive assumptions. Okay. That's how we can be successful. And it's hard to find those deals, but it's a volume game. And so, we have the same subscriptions, CoStar and RealPage, which are the leading multifamily analytics resources, and they have a national database. Okay. So we use the same data, the same line of thinking in Dallas that we do in Phoenix. Here you see a sensitivity analysis for an equity multiple. Take a drink real quick. This just shows you if you take these assumptions for stabilized organic rent growth and exit cap in this matrix, what the returns look like. And so we feel that these are very conservative assumptions based on CoStar, RealPage, what we're hearing from other people, lenders in the market, and you see that sensitivity analysis. All right, here's a new slide that you have not seen from Phoenix deals. And so, many of you who are familiar with Texas in general know that, one of the big downsides or really the negative connotations of the Texas market is that the property taxes can be very high, right? In Arizona, we have fixed property taxes cannot increase by more than a maximum of 5% per year. Okay, so we can underwrite that, be very conservative. And if you're an investor and you're looking at us, Rise 48 going into a new market like Texas, one of the biggest, risks associated with that is like, hey, do these guys know what they're getting into with property taxes and insurance? Okay. And so the answer is yes. We've been aware of this for a few years because we have a ton of LP investors, thousands of them in our database, and have invested in, many of them have invested in Dallas and told us about this. Okay. And so what we did is we talked to all the local brokers, we talked to all the local lenders, and we said, who is the top tax consulting company in the market? And literally all of them didn't hesitate, said, you need to call Mark Cantrell. Mark Cantrell is the CEO and owner of Cantrell McCulloch Incorporated, CMI, and they're the leading group for property tax consultants. So what they do is they'll build out a pro forma projection for what they think your taxes will go up to based on the county of the asset, because each county has its own, tax rate and maybe more aggressive or less aggressive. And then they also, you'll engage them each year to fight the county and basically litigate on your behalf. Okay, this is just like a cat and mouse game that you have to do in the Dallas market, because what's happened is these counties, will kind of overcompensate, come in really high on their tax assessment, because remember, Texas does not have a state income tax. Well, what they do is they compensate for that through property taxes. They really gouge people for commercial and residential homeowners. I was kind of blown away at what my property taxes are in my monthly mortgage I have to escrow for this new house I bought. It's crazy. So what they do is for these commercial properties, they come in really high, and then you need to hire a consultant to basically contest it and just show them data and threaten to litigate them. And everybody does this. Okay, this is like a common thing now, and they know that it's going to happen. So they'll start out high, you knock them down and fight them. Okay, and so CMI has created a forecast for us, and you see this in the lower right-hand corner. And they said that the most conservative probable projection for property taxes for 2023 is $653K. They said it's very unlikely, kind of doomsday scenario, the max would be 739. In our model, we're assuming 735 as our forecast. Okay, so we're about $80,000 higher than what they think it'll come in at, and only about 4,000 below the very worst case scenario. So we feel like this is a very conservative 2023 forecast. And we've seen dozens and dozens of Dallas investor decks and webinars the last several years. Okay, I actually met my partners, Bick, Ron, and Robert. We all met at a conference in Dallas in 2018. We used to go to these conferences a lot in 2018, 2019 in Dallas. We know all the top sponsors there, and a lot of them are friends of ours. In these decks, not to say that, not to be critical, but one thing that we've noticed is that most sponsors in Dallas will assume an increase, in year one, and then years two through five, they'll just assume a stabilized 3% expense growth rate. CMI and Mark Cantrell told us that's not how you do it. Okay, he said that this would be very conservative, and this is actually probably higher than what's reality. But what we're doing is that we're assuming in year one, 75% of the market value of the asset multiplied by the estimated tax rate for that county. Year two is 80%. Year three is 85%. So we're building in these massive increases in property taxes into our pro forma, and the returns that we're showing investors are net of that. Okay, and this is a very important thing to do for the Texas market. And then years 4 and 5, he advised us that you can use conservative stabilized growth of 3% each year over year after that 3-year mark. And so long story short is that we've really done our homework with this. We feel like we've comfortably and conservatively underwritten the property taxes, and that our returns account for all that. Let's talk about the highlights of the investment. So we talked about the interiors. We're also going to completely rebrand the exterior. So it's currently called Paces Cove. We're going to rebrand this to Rise at Highland Meadows. We'll do our same 3-tone exterior paint that we do in Phoenix. So our vendor, actually our painter, his name is Dino's Painting. He's actually going to paint all of our assets in Dallas. So he has a huge Sprinter van. He's going to drive out his crews for every deal and all of his equipment and give us the same cost. Okay, so we can build that into our budget. So we're going to use the same exterior painting group, and he'll do a really good job with that. We'll do a permanent monument sign with an LED backlight. We've already sourced vendors for that. New banners, improving the landscaping. We'll redo the pool areas. There's 2 pools. We'll restore the pool deck, new sail shades, new furniture. We had multiple vendors out for that as well. And then, like we mentioned, we'll upgrade 100% of the interiors. Like we always do, we always have reserve funds budgeted for any CapEx items like HVACs, plumbing, things like that. So it's a clean asset overall, and we'll really kind of spruce up those amenities. Okay, here you see the interior renovation scope. many of you may recognize this is the exact same slide we use for Phoenix, and that's because we have the exact same supplier and same materials, like we said. And so this is an example of one of our assets, before picture and after. This looks very similar to what's at, Rise Highland Meadows right now. It's the same vintage of property. You've got original cabinets, original countertops. We'll come in and do quartz countertops, undermount sinks, subway tile backsplash, stainless steel, brand new cabinet boxes, not just new doors. And so same exact high level scope. And here you see a CapEx budget. And so we're coming in at the same price for our Phoenix deals. Okay, so we're typically between 15.5 to 16.5 on interiors in Phoenix. We have fixed pricing with our supplier. So they were out there with us. Our supplier toured the deal with us during due diligence. They took measurements of every single floor plan so that we can create this budget. So this budget is dialed in. And like I said, we have our same exterior paint vendor. So we know that that's a locked in number. And these other vendors, we relied on our local regional vice president, our regional property management director, and then our asset manager with trusted vendors that they've used time and time again. Okay, so we feel really confident in this CapEx budget that it's dialed in. And so we have just over $9.2 million total CapEx between interiors and exteriors. 5.4 is just allocated to the interiors, those 328 units. And like I mentioned, we not only do property management in-house, control the supply chain, but we also do all the construction management. Okay, so we're sourcing, bidding out, and managing all of our own vendors, construction crews. And then our staff is literally walking units every single day, making sure they're staying on schedule and on budget. Okay, and we'll go into this in the next slide, but the lender is financing all of our CapEx, okay, which is really nice. So we're not raising this money from investors. This is all lender financed. And so just like we do on the majority of our deals, we'll do quarterly draws to the lender. So we'll basically go through, start renovating immediately. And then each quarter, our accounting team does draws to the lender where they reimburse us for what we've spent. And something that we build into this, which the lenders pay for, is a construction management fee. Okay, so we charge 5% of the total budget. Okay, so assuming we get through everything and we don't sell before renovating all the units, that's about $438K. But to be clear, investors don't pay that. Okay, it's part of the total loan proceeds. And that helps us to cover our overhead for buying materials, staff, and managing the entire process. So this kind of gives you an idea of what the CapEx budget looks like. And again, same process, like we mentioned, our construction manager, whose name is Dallas Martinez, the individual, he has moved out to Dallas, the city. Okay, and so he's been running our construction management in Phoenix, and he's going to spearhead the effort. He's been the one working with our supplier, all the contacts. So we feel really comfortable that we have the same process in place there. Let's talk about the debt financing. So this is probably the most relevant slide that people want to see, right? Because of all the volatility the last year or so with financing. And so this is a debt fund bridge loan, a very conservative, low leverage loan. Okay, so we've always been a lower leverage group in general, but this is only 56% loan to value, okay, which means that we have about a 44% cash down payment. So we're very low leverage. We have a ton of cash equity in the deal. You can see that's nearly $22 million of loan proceeds on the purchase price. The lender is going to finance 100% of the CapEx rate, or the CapEx, I should say. The interest rate on this deal, we've purchased an interest rate cap. Okay, so obviously the biggest concern, in the world is interest rates. Where are those going? Interest rates right now are at least 7 to 8%, for pretty much any lender, banks, Freddie Mac, debt funds, et cetera. And so we feel like, and by the way, we've done all types of loans. We've done Freddie Mac fixed, we've done Freddie Mac floating, we've done debt fund bridge loans. So we quoted all of these. We even quoted life insurance companies. This loan product that we got is by far the best for this business plan. Okay, and we've experienced doing all of them. And so I'll kind of go into it here. What we've done is that we've paid extra upfront to buy a very low interest rate cap. Kind of similar to when you buy a single family home, how you can prepay your interest or to buy down your interest rate. That's what we've done here. Okay, so we've prepaid to buy a lower interest rate cap at 5.05%. This is a 3-year interest rate cap. Our interest rate cannot exceed 5.05% for the first 3 years, no matter what happens. Okay, with the Fed, the treasuries, the index, whatever, it cannot exceed that because we've kind of prepaid that. And this is a 4.5-year loan. Okay, so it's a 36-month loan. You have a 12-month extension and a 6-month extension. So we can make it a 4.5-year loan. And these extensions are very nominal. It's about 25 basis points of loan amount to extend if we need to. And so we feel really good about this. This is what we've done the majority of our assets. And this is just lower leverage. This is what's called a floating or adjustable rate loan. Many of you may be thinking, well, wait a second, isn't that risky to do a floating or adjustable rate loan right now when interest rates are going up? Okay. And so I'll kind of explain to you why we do that. But first off, the way we can mitigate against a floating rate loan is, like I just talked about, by buying a low interest rate cap on the front end. So we've almost, kind of engineered a 3-year fixed rate loan because we've bought a very low cap, and we'll be at the cap day one. Okay. We'll immediately be at that. The returns that we're projecting to investors is net of this max interest rate. Okay. And, for all of these deals, we'll show you soon that we're having no problem increasing rents, forcing appreciation, increasing NOI. The plan would be most likely to refinance the deal or sell prior to year 3. Okay. So we could refinance in like a 10-year Freddie Mac loan, which we've done several of those. The reason that we do the floating rate loan as compared to a fixed rate loan is because the prepayment penalty. Okay. And I know a lot of people are kind of freaking out the last 6 months saying you need to do fixed rate financing. That's the safest route. We think fixed rate financing is very short-sighted. Okay. And I'll tell you why. We've done 2 of them, and it was a big mistake on our end. It was 2 of our very first deals. I think it was like our 3rd and our 4th deal back in 2019. And there were 10-year Freddie Mac fixed rate loans. Whenever you do a fixed rate loan, regardless of the lender, whether it's a bank, Freddie Mac, a debt fund, there's a price to pay. Okay. If you do a fixed rate loan, you get hit with a very nasty prepay penalty called yield maintenance or defeasance. And the reason is that if a lender gives you a fixed rate loan, they're guaranteeing that your rate will not change. Okay. So let's say you do a 10-year Freddie Mac fixed. Well, the lender has a lot of exposure there because if interest rates go up in the market, then they have to cover that, right? And so the way that they cover themselves is they hit you with this nasty prepay penalty called yield maintenance or defeasance, which means that they're going to make their entire yield they would have made on that entire 10-year loan, regardless of when you sell the deal. Okay, so we had a deal called Villa Serena. We bought it in 2019 for 17 million. And when we sold it, it was a fixed rate loan. We had yield maintenance. We had a $3 million prepay penalty right off the top. $3 million of cash that came out of investor pockets just to pay the prepay to get out of the loan. Okay. And so we had to hold that deal for 8 months longer than we wanted to, just to keep renovating, keep increasing the NOI so we could absorb this massive prepay penalty and still net out our investors a 2x plus return. And that was when the market was really strong, right? And so we think that, it's very short-sighted. The only reason you should be doing a fixed rate loan right now, in our opinion, is if you're modeling at least a 7 to 10 year hold. It's a long-term hold type of strategy, because even if you increase the NOI, even if you're in a strong market, especially now the organic rent growth has slowed down, fixed rate financing prevents you from getting out of the loan. It doesn't give you flexibility to refi out and return capital to investors. It doesn't give you flexibility to sell, in a few years in 1031 exchange. And so we really like this because this deal has no prepayment penalty. Okay. So we kind of get the best of both worlds. We're low leverage. We've really kind of engineered a fixed rate loan by buying a low cap on the front end. And some people may be saying, well, wait a second, in 3 years from now, what if your rate cap expires and then interest rates are higher than the market right now? Well, that's okay, because we can buy another cap. Okay. You can buy another cap on the deal and get even a lower interest rate if you wanted to. Like right now, we've done a few deals recently. One was at a 4.75% cap that we bought. This one's a 5.05 cap. And, a lot of the deals that we bought in 2021, those caps are between 5.5 to 6.5%, because we weren't buying such lower caps at the time because people didn't expect interest rates to go up so quickly. Okay. So you can always buy down the cap on the front end and really protect yourself. So, and I can go over debt questions at the end. I'm sure there's always questions on debt. But as you can see here, we're really kind of capping that out. This next slide, we always have an interest rate sensitivity analysis where we show investors what your return looks like with different scenarios of interest rates. On this one, we're just showing you the max interest rate, okay? Because we don't think it's realistic the interest rate's going to drop below 5.05 the next few years, okay? We just don't think that's realistic. So it'd be kind of misleading to show you lower interest rates. This projection is assuming this max interest rate, 5.05. And here you kind of see an explanation, which you can kind of read through in the deck, of what the interest rate is composed of between the spread from the lender and then the index. All right, here you see the exit strategy. We kind of talked about this a little bit. We want to have a flexible prepay penalty so that we can either refinance out of a deal, return capital back to investors, or sell the deal early and truly maximize the returns upon that exit. That's why we like to do that flexible prepay penalty. let's talk about the asset itself. And so like we said, $39 million purchase price, 19 total buildings, 328 units, average unit size is 670 square feet, 1983 vintage. That's kind of our bread and butter. This is right down the fairway of what we always do in Phoenix. Same business plan, individual air conditioners. You have brick construction. A lot of 80s vintage in Dallas is brick, whereas Phoenix is wood frame construction. So it's just kind of a local thing. Looks nice. And we're going to basically do like a whitewash paint on the brick. So it'll look like a nice whitewashed white brick, will look very clean and elegant. And then you got pitch shingle roofs. Here you see a renovations case study from 2021. Okay, so here we wanted to show you 15 deals that we purchased in 2021. In the striped bar here, and each of the properties is listed at the bottom. The striped bar for each asset shows you what the projected pro forma rents were before we bought the deal. So in a little bit, I'm going to show you what our pro forma rents are for this opportunity, what our post-renovation rents are that we're projecting after we buy the deal, we renovate it, and start leasing up units. The stripe bar shows that for every asset. The solid blue bar shows you actual performance for rents. As you can see here, across all 15 of these deals, we not only have met our pro forma rents, but we've drastically exceeded them by an average of $73 a unit. Okay, this is over 400 units renovated to the exact same scope, same materials, same supply chain that we're using on this deal. Okay, and if you were to take a conservative 4.5 exit cap and you take $73 over our pro forma, that would be over $19,000 of additional value for each unit you renovate upon sale, which for this deal would translate to over $6 million of additional upside in the back end. Okay, we're not underwriting that into the model. This is not being assumed. This is just showing you potential upside, based on what we've done historically. And as you can see here, we've already sold 5 of those deals. And the major reason why we were able to sell them in such a short amount of time, we bought them in early 2021, was because we were exceeding these pro forma rents. And many of you may be thinking, okay, that's fine. But 2021, the market was really strong, right? You had tons of rent growth that was pushing you up. 2022, rent growth really plummeted across the country. And so we wanted to show people 2022 renovation case study. Okay. In 2022, we bought 11 different assets. And you can see here, same bar graphs. This is the projections, and the dark blue, or the solid blue, I should say, are actual performance. We not only met, but exceeded the pro forma rents on every single asset. We renovated even more units in 2022. Over 600 units, we exceeded pro forma by an average of $48 a unit. Okay, so this drastically increases the value. And this is when organic rent growth was really slowing down. So we wanted to illustrate to investors that we are not banking on organic appreciation. Okay, we are truly forcing the appreciation by offering a higher quality product. And going forward, the last 5 to 7 years, most sponsors can just buy a deal, do nothing. The cap rates compress, the values go up, you sell it, and you look like a genius, right? You got a strong return for your investors. And you didn't have to actually force appreciation. You didn't have to execute a business plan. Well, those days are completely over. Okay, going forward, the superior operators are really going to separate themselves, because in order to hit returns, you have to actually execute a value add plan by renovating on schedule and on budget to push the rents, because people are going to pay for a higher quality product. And you can see here, we've renovated over 1,000 units across the Phoenix portfolio just in the past 24 months. And so we feel very confident we can crank through these renovations with this same type of approach on this asset. And we just wanted to show you that this is kind of what we've built. And again, our construction manager, whose name is Dallas, he just moved to the city of Dallas to lead these efforts. Okay, so we feel like we can translate the same performance to the Dallas market. Here you see a unit mix breakdown. So like we said, it's majority 1 bedrooms. They're pretty good size 1 bedrooms. This horizontal bar here at the bottom shows you our total projected rental increase as it relates to loss to lease versus renovation premium. So it shows you the concentration of the rental increase. The dark blue is loss to lease. Loss to lease means that we personally secret shop these comps. Our asset management team did it. I did it separately from them, just as like a gut check type of deal. I went into all the assets, like I said, and personally talked to the managers, toured the units, and we'll go over that shortly. And we looked at what rents are being achieved for classic unrenovated units right now in the submarket, and what rents are being achieved for renovated product. Okay. And then we create our pro forma to be right in line. Based on our market survey, there's at least $109 on average of loss to lease alone, meaning that we can push rents up $109 on units without even having to renovate them each month as leases expire, just because this seller has not been pushing rents, and they just haven't been a good operator. And that's why they're kind of in trouble, have to be a distressed seller. And then you see here, we have an additional $230 conservatively for the units that we renovate. We can push those rents up even more. Okay. And so you've got a really big premium here between both. This is a very conservative strategy where over 30% of our total rental increase alone comes from loss to lease. Okay. So we don't even have to, get this entire premium just by renovating. So it's really kind of a hybrid approach where we have loss to lease, which demonstrates the operational upside. And then we have that renovation premium by renovating the units and providing a higher level scope. Let's jump into the financial analysis, some of the key assumptions. Like we said, $39 million purchase price, $25 million of equity. You see here kind of the summary of those return classes. You're going to really want to focus on Class C as an LFI investor, unless you want higher cash flow. You can do Class A. And we've got our sources and uses here. So I'll let people kind of go through that on their own time as far as the reviewing the slide deck. Class C, like we said, 8% preferred return to LFI investors if you invest at least 50K. After your 8% preferred return is caught up, it's an 80-20 split where 80% goes to you, the passive investor, 20% goes to us, the sponsor. And then there's no second hurdle. So it's 80-20 regardless of the upside. Here you see a 5-year pro forma. And so this really just kind of shows you, what we're projecting for total rental growth, things like that. And so, there's a lot of info here, but what I'll focus on is the total rental revenue year over year change. If you look here, almost all of this is from forcing appreciation by burning loss to lease, renovating units. Okay. This is what this rental revenue is coming from. In year one, we're assuming only a 4.4% total rental revenue increase. Okay. Remember, we're assuming 0% organic rent growth. This 4.4% is coming simply from burning loss to lease and renovating units. And we always model in our deals, and this is what's happened in reality, is that we're going to execute the plan and renovate the interiors in the first 24 months. As a conservative estimate, we're really bleeding out this total rental increase from loss to lease and from renovations, like over the first 3 years. We're realizing the bulk of it by the end of year 2, because as a conservative measure, we're thinking it's going to take a little bit longer to penetrate the rent roll and start increasing rents, burning loss to lease, and then get through all those units. So this is a conservative approach where, we're not assuming a massive rental revenue increase in year 1. In reality, we've always had significantly higher rental revenue increases in year 1 because we can crank the units pretty quickly, but we don't want to model that out in the underwriting model. Here you see some of the key underwriting assumptions. So, economic occupancy is a combination of physical occupancy and then delinquency, loss to lease, bad debt, things like that. Organic rent growth is very important. We talked about how we use data from historical rent growth, forward-looking rent growth, and then what we're assuming, which is more conservative than that data. So we're assuming 0% in year 1 and an average of 3% year over year over the 5 years. The expense assumptions is something that we always have dialed in because we do the property management in-house. Okay. And this is why we created the property management company, is to have complete control over this. And so we did not create the property management company to really make money. Okay. If you want to make money, do not create a property management company. It has crappy profit margins, does not make a ton of money. We created the property management company to have control and to make sure that we control the operations and the expenses. So we always hit our expense assumptions, and we have a really good idea of what payroll should cost by underwriting a ton of deals, talking to different groups, hiring our local staff. And so we're very confident our expense assumptions are dialed in and that we will control all of that. And then the interest rate we talked about, we have that interest rate cap where it cannot go over the 5.05%. And so we really be able to mitigate, interest rates that may go up in the future. Here you see a break-even analysis. And this shows you basically what the physical occupancy would have to drop below in each year, years 1 through 5, in order for the property not to be able to cover its own operating expenses and its own debt service. Okay. And so here in year 1, it starts out the highest because, we started at 74.8%. So if we drop below 74%, then the property cannot cover its own operating expenses and debt service. To give you an idea, we never go this low in any asset. Okay. We're typically, 80 to 85% is the lowest we'll typically go for physical occupancy. And that's on purpose because we're renovating units. We're forcing vacancy to crank through units and renovate them. And then as you can see here, as we're increasing rents, increasing revenue, your break-even point goes down. Well, we have enough operational reserves in place to where we could start out day 1 at 65.5% occupancy. We're raising over 1.9 million of cash reserves, which are not allocated to anything. Okay, this is separate from CapEx, interest reserves. This is completely separate. This is just a rainy day fund of cash sitting in the property operating account so that if we ever drop below our break-even occupancy point, we have a ton of cash liquidity to cover those expenses. So as you can see here, we can start out at 65% day one of takeover and stay there for over 5 years, which would be unthinkable. You'd have to just completely be negligent to have your property, especially property this large. That's a lot of units that are vacant, 328 units. And so we have enough cash where we could be there for over 5 years and we would not have to do a cash call to investors. We have enough cash to cover all of our operating expenses and our debt service. And again, we've capped the interest rate there. The property is currently over 96% occupied. Like we showed earlier, the submarket statistics are projecting 95% occupancy going forward. Okay, so it's a very conservative approach, and we just wanted to show you this is one of the major reasons why we have not had to do any cash calls on any of our portfolio and why we have no concerns in the future. Okay, some of these other sponsors that have floating rate debt, they'll have a cap, but their debt service shot up so quickly up to the cap, and the NOI couldn't keep up with it. If you don't have cash reserves to cover that delta in between, then you run out of cash. And so you either have to do a cash call to cover your operating expenses and pay your debt each month from investors, or you have to sell the deal, like a fire sale, which is what these guys are doing because they're coming up on a balloon payment for their loan. So this just shows you how we think about this and why it is conservative, and we don't have any concerns because we've always done this. We really, liquidate, or not liquidate, we well capitalize the asset and keep a lot of liquidity on the front end. Here you see the projected return summary. You can just focus on Class A, Class C. This really kind of just goes over an earlier slide. Let's talk about the Dallas market here, and then we'll wrap it up shortly. Here you see the Dallas MSA. So like we said, this is the premium Northeast Dallas submarket. This is a B location, B class asset. We talked about SMU. You've got ACOM, Texas Instruments, over 10,000 employees nearby. You've got major headquarters of national companies all throughout this MSA. And we talked about how DFW ranked #1 for population growth from 2020 to 2021. They're among the top cities for personal income growth. So when we're looking at a market to identify, we wanted similarities to Phoenix, right? We're always looking at strong fundamentals. What do fundamentals mean? Fundamentals mean job growth, population growth, income growth. Okay, when you have people that are making good money and there's more people than there is housing available, it benefits us as investors. Dallas has all these same qualities. And so you can see, we talked about earlier, #2 for job growth in the US last year, according to US Bureau of Labor Statistics. And then just like Phoenix, a lot of the data from like US Bureau of Labor Statistics has not caught up to show the tech job growth. So we were actually shocked to see that, not shocked, but we didn't know this because we were researching the market. Dallas, DFW is #1 in the US for tech job growth in 2021. Okay, so it's attracting a lot of different tech jobs. And then we talked about how the single family median sales price is $440,000. It's just simply not affordable for the bulk of the population, especially with interest rates so high. You have to earn so much money to even qualify to buy a house like that. It's pushing more people into these units. And not only, forget single family homes, let's talk about Class A luxury apartments. In Phoenix right now, we're seeing a ton of trickle down where Class A tenants are trickling down into our Class B product, because our average rent in Phoenix is between $1,100 to $1,300 a month. Okay, and we have these nice interior finishes. You don't get all the attractive modern amenities that you're going to get at a Class A new build, but you can be paying $700 to $1,500 less a month. We have the same type of dynamic happening here in Dallas, which really helps these Class B properties. You see some of the major employers. You talked about the top 3. You've got AT&T has their headquarters in downtown, right over by, I can actually see it out of my office window at our office, the AT&T headquarters. Over 5,900 employees just in downtown alone. Kimberly-Clark has over 10,000 employees. Southwest Airlines has been in the news recently for all the wrong reasons. Regardless, they have a lot of employees, all right, 10,000 plus employees. They're headquartered in Dallas. And some of the recent news, Goldman Sachs is designing a massive office, which will have 5,000 employees in the local Dallas market. You've got all these big companies, Samsung, Caterpillar, all these big groups are investing a lot of money, in this market. And obviously, if they're going to invest, millions of dollars, they believe in the sustainability, long-term infrastructure of the Dallas market. This just provides more stability, diversification, and really just attracts more jobs. Okay, just like we do in the Phoenix decks, we want to provide you with a similar slide of Dallas job data. Okay, this is from the U.S. Bureau of Labor Statistics. So we just pulled this a few weeks ago. So this is, as up to date as they have. And this shows you really the breakdown of the employment sectors in the Dallas MSA, okay, based on categories and industries. So some of these categories have multiple industries in them. And so, whenever we're looking at a strong insulated market, we want to look at diversification of employment. This is one of the reasons we chose Dallas, and we don't want to touch Vegas, okay? Because Vegas is still heavily concentrated, in hospitality, tourism, et cetera. But, Phoenix and Dallas have some of the most diversification, the best diversification in the country of their employment sector. So as you can see here, there's no one category that makes up more than 21% of the employment base in the Dallas submarket. And some of these, trade, transportation, utilities have different industries in them. So you've got education, professional services, financial activities. And again, a lot of this data has not caught up to reflect all the tech job growth coming here too. I mean, these government, agencies are typically a few years lagging with their data. And so there's a lot of tech job growth too. So, whenever there's a downturn, you want to have a lot of diversification in your employment base, so that you're not exposed to any one industry kind of taking you down. And so because it's diversified, there's a ton of jobs, a ton of people, we feel really confident in this Dallas market. Let's go through the comprehensive market survey. So like we mentioned, just like we do in Phoenix, we did the same type of approach, same methodology for the Dallas market. We personally secret shopped all of these comps. Okay. So our asset management team, they were out there shopping all the comps in person. And then I drove separately with Brady, our acquisitions guy, and we went and shopped all the comps ourselves because we wanted to have a check and balance for acquisition or our asset management team, make sure that they did a good job, which they did. Everything was the exact same. But I went in there personally, talked to every single manager, and said, okay, what are your rents for renovated product? What are your rents for unrenovated product? What are you charging for utility reimbursement? What's your base rent, price per square foot? What amenities do you have? And so you see here our rental comp survey. So we went and shopped 5 different assets, all within less than a mile of the asset, all the same vintage, similar size. Okay, so we feel like these are true comps. This is the true competition when a prospective tenant is looking for an apartment in the submarket. They're looking at these assets compared to this one. So as you can see here, you have 1 bedrooms, you have 2 bedrooms. In the blue, this blue horizontal bar, you have the average rent that's being achieved right now. Okay, today this is being charged right now is the average among all of these comps. In these red, and there's multiple because we have multiple floor plans. Okay, we want to be very detailed, and there's 4 different floor plans, different sizes for the 1 bedrooms. Each one of these floor plans in the red is reflecting our post-renovation pro forma rent. This is what we're assuming that will hit after we renovate the unit to our high level scope. And I can tell you from seeing it personally, none of these comps have the same level of scope as us, except for this deal, Tides at Highland Meadows. And that's because Tides has the same exact, same supplier. They don't do a very good job operationally though. They've bought a bunch of deals. And so it's not similar, but it is similar, but it's not the same operations. These 4 deals have an inferior interior scope. And so again, we're not trying to reinvent the wheel here. We're saying that after we renovate units to our scope, we'll be at these levels. You can see that for both the 1 bedrooms and the 2 bedrooms, we're right in line or below what's already being achieved today. And so when we showed you, the renovations case study that, in 2022 alone, we renovated over 600 units. We are exceeding our pro forma rent on average by $48 a unit. It's because we do this. These are not very aggressive rents. They're very achievable, conservative, and we've thoroughly shopped them out. We don't rely on CoStar or apartments.com for rents because they're often, outdated. They can't be shopping them every week. And so this is what we do. And this is why we've been able to really exceed our projections in a much shorter amount of time, because these are thorough and thoroughly shopped comps, and we do our due diligence. Here you see a sales comp slide. And so we took all the most recent sales in the Dallas market, similar vintage, similar size. You can see the average price, and a lot of people won't have access to this data because Texas is a non-disclosure state, right? So these prices don't get advertised publicly, and you can't find it in public records. So what we had to do is reach out to all the top brokers who sold the deals, and they gave us all these numbers. The average price per unit across these sales comps, $167,000 a unit. Again, we're buying this deal at a very low cost basis. We're not exaggerating. This was a distressed seller. We have it at $119 a door. Okay, so well below what other deals have been trading for, and also obviously well below the replacement cost for single family homes, like we showed, median sales price of a home is $440,000. Okay, so that's the sales comps. We feel like we're getting a really good basis here. To the acquisition timeline. And so we executed the PSA December 7th. We launched the deal to our investors just yesterday. Deadline to execute documents is January 24th. The funding deadline is January 27th. If some of you need a little bit of an extension for funding, that should be fine. We've pretty much already have committed most of the money. We've carved out allocation for LFI. And so LFI investors actually, could come in a little bit later if needed, because we'll be good to close. And so we're planning on closing the deal February 9th. So just let us know if you need a little bit of an extension. We're going to begin the reporting in March. Conservatively project to begin distributions April to May. If we have a smooth takeover, we may start that a little bit sooner, which we often have done. That's kind of the timeline. And then we'll jump into the Q&A here. And so, I've got about 5 minutes here. I know that we kind of ran long.
Hey, Zach.
Yep.
There are a ton of questions. Would
Sure.
you be open to, if I sent you an email and you could answer each of them in writing, and then I will send out all of those answers with the recording, hopefully tomorrow early?
Yeah, you know what? I know this is important. I want to address these questions. Let me see if I can move back this meeting. One sec. Let me hang on here and try to answer some of these questions. Anything we don't get to, I can do that, Jim, for sure. But I don't want to leave people hanging here. Let me just text them real quick. One sec. Sorry.
All right.
Okay. Yeah. Do you want to read through the questions, Jim, and then I'll try to get this knocked out here.
Yeah.
Or so.
Let me go back to the first one. In Phoenix, your crews were well known and understood the RISE 48 process. What are you doing to mitigate potential crew/labor issues?
Yeah, good question. So, first off, we have the same construction manager who's overseeing all that, and construction management is our staff, right? That's our people. What we do though is we'll use third-party labor, third-party construction companies. In Phoenix, we have like 9 or 10 different construction companies we work with consistently. All of them have multiple crews, which gives us a lot of bandwidth. Almost all of those companies were referred to us by our supplier, okay? Because they work with the biggest clients in Phoenix and the biggest clients in Dallas. And so they know which companies are the most proficient. And so they've done the same thing for Dallas, the Dallas market. I met with 2 of the top construction companies myself. I met with the owners when I was in Dallas in early December. And one of them is doing 150 to 200 units a month, cranking out renovations. The other one can do 100 to 150 a month. We have 7 to 8. We had 7 to 8 groups that toured the property giving us bids. And so, our construction manager, Dallas, and our asset manager, Tim, will be sourcing and managing these groups. We also hired a construction coordinator. His name is Daniel. I just met him earlier this week in Dallas, and he'll be, walking the units daily for this asset. As we buy more assets, we'll expand that out. And so we've been referred to the top construction companies who are familiar with doing this scope and doing very high volume. So we feel really confident about that construction management process and the labor.
Excellent. What's the break-even occupancy rate?
I think we went over that. I think that question was probably asked.
Before. Okay.
Yeah. So I think, in year 1, it was 74%. Then it starts to drop.
Right.
But like we showed, we have a lot of reserves in place. So we could be at 65% day 1, stay there for over 5 years. And we have enough reserves to not have to do a cash call and have enough to cover the expenses.
Okay. And then can you comment on other expenses such as insurance, which are higher in Texas compared to Arizona? I know you talked about taxes.
Yeah, good question. I forgot to mention that because that is an important thing. So in Phoenix, we've worked with 3 different big national insurance brokers, who cover multiple markets. And we've got one main guy who's very experienced in the Texas market. Okay. So right now we have a blanket policy in Phoenix for all of our assets where we get reduced pricing. We are going to have a separate blanket policy in the Dallas market for Dallas assets, because you're right, insurance is much higher in Dallas. And so we've talked to these top 3 consultants. We're using our main insurance broker who has a bunch of deals he already insures. And we've already talked to actual insurance carriers as well. And so in the model, we're not just trying to use some rule of thumb or some what somebody said we think it'll be. We've talked to actual carriers who have already given us hard quotes on the insurance price per unit. So the returns that we're projecting are including insurance assumptions from actual carriers that are hard quotes. And so we feel really confident with that. And again, it'll be a separate policy from Phoenix. We don't want to, increase the cost of our Phoenix blanket policy by throwing in Dallas. So that has been accounted for as well.
Okay. Someone asked, we heard there was a pause of distributions on other RISE deals. Can you comment on what happened in those deals and if it's applicable in this deal or can be mitigated?
Yeah, great question, John. So we have 27 assets right now in the Phoenix market, and we've paused distributions on 4 of those. Okay. All 4 of those were purchased between like second quarter, third quarter of 2021. Okay. And so in 2021, interest rates were not projected to shoot up like this. So we did have cash reserves on all of those deals, but we weren't raising like 2 to 3 million a deal because it wasn't necessary. And the interest rate caps we were buying, like I talked about earlier, were between like 5.5% to 6.5%. And so because, nobody saw this coming, even the biggest institutions in the world, Chatham Financial is a big resource people use. We always reference that. And nobody had interest rates shooting up 400 plus basis points in 2022. And so for those deals, and again, there's only been 4 so far. We basically have plenty of reserves in place, but we wanted to just be proactive and temporarily pause distributions until we can increase NOI even further or until interest rates come down. Okay. So when we pause distributions, it's purely to be proactive and make sure that we're maintaining liquidity at the asset level, again, so that we never get in any danger of having to do a cash call or running out of cash. And again, we're doing these monthly stress test analyses on every deal, which where basically our team is taking the max interest rate and we're up to the cap and we're extrapolating that over the next 36 months. So we're assuming the max interest rate for the next 3 years, which again, most people think that 2024, 2025 interest rates will start to come down from where they are, but we're assuming the max interest rate for 3 years. And then we're shaving down the NOI significantly. Typically, we're projecting around, depending on the deal, like 2 to 3% NOI growth a month in these deals in the first year or 2 as we're doing the renovation plan. And then we're shaving it down in the stress test to about 1% a month. The whole point of the stress test is to see, do we run out of cash? Okay. And on none of these deals, we run out of cash in that model. Okay. So we don't plan on doing any cash calls or anything like that. But the 4 deals out of the 27 were purchased in that middle to fall period of 2021. In 2022, we started raising much more reserves. We adjusted our underwriting to fit the current economic climate with financing. Okay. And so we were purchasing lower interest rate caps. We raised significantly more operational reserves, and we don't plan on pausing any distributions for any 2022 acquisitions. We're very confident on that. So it is a handful of those 2021 deals. And we told investors too, is that if we pause distributions, that's not going to impact your overall return. It's not like we're taking money from you. You have a preferred return that protects you and it's accruing. Okay. And so once interest rates come back down, we will fully catch you up. Or if we do a refinance or a sale, we'll fully catch you up. And so upon a sale, we catch you up in your full preferred return and then split the upside accordingly. So yeah, we have paused 4 out of the 27 as a precautionary measure. And I've talked to a lot of sponsors. I have friends across the country in, Dallas, Florida, Sunbelt markets, and a lot of people have paused distributions just to kind of maintain liquidity. But for us, it's a small percentage of the portfolio. There may be 1 or 2 other deals that we have to pause like around summertime, but it's not a lot. And again, none of the 2022 acquisitions we expect to have to pause because we have a lot more reserves, lower interest rate caps. So that's kind of our philosophy there.
Okay. And you mentioned the rate cap is for 3 years. If rates stay persistently high, any concern that the rate cap escrow will be high and wipe out cash flow?
Yeah, good question. And so as part of this analysis as well, we're also doing like an NOI projection on where we need to have NOI in order to qualify for like a 10-year Freddie Mac loan. Okay. And so Freddie Mac has a 1.25 DSCR. And so we can actually calculate the amount of proceeds that we would get from Freddie Mac if we budget to have this certain cap when we do a refi and we have X amount of NOI. And so if we can conservatively assume we're going to renovate X amount of units to achieve X NOI by this date, then we feel confident we can at least refinance out of those loans prior to the end of year 3 into a 10-year Freddie Mac loan. Okay, so some of the deals that we bought in 2021, for example, and we have 3-year interest rate caps in every single deal in the portfolio. We've sold 11 deals since we started. The longest deal that we own was purchased in June of 2021. Okay, so we're about 18, 19 months in, meaning that the cap will expire in the summer of 2024. And on those summer deals of 2021, we blew through renovations. We did like 30 to 50% in like the first 9 to 12 months. And then we stopped, we hit the brakes on purpose, which we've done the last several years, so that we could leave meat on the bone for the next guy, you know, to sell the asset. Well, now that interest rates started going up in second half of Q3 and in Q4, we started to pick up renovations again as we were having non-renewals. We didn't want to go full blast in Q4 because with the holidays, it's not the peak leasing season, so we didn't want to create too much vacancy. Now that we're in Q1, we're firing up renovations across the portfolio and going full blast velocity. And the plan is, and this especially applies to 2021 deals, not really we are going to renovate 2022 at a high pace, but for 2021 deals, the whole philosophy is by the end of 2023, we've renovated the majority or 100% of the units at the asset, so that worst case scenario, if interest rates don't come down, which I don't think they'll come down in 2023, to be clear. I mean, I spent the holiday break reading outlooks from like Goldman Sachs, JP Morgan. Most of these big groups are projecting that interest rates plateau around the summertime this year. They stay there, and that in the beginning of 2024, the Fed starts to cut rates, you know, somewhat aggressively. So, you know, we're assuming interest rates don't come down this year, and that, you know, with that, we'll have maximized the NOI at the asset so that we can qualify for a 10-year Freddie Mac loan to refi. And worst case scenario, you know, even if we have enough loan proceeds where we don't return capital to investors, we at least, you know, take out the bridge loan, and you can put a new interest rate cap on that deal with Freddie Mac. Okay, and we've done several of those Freddie Mac loans. So, you know, the whole plan is basically you maximize NOI or executing your business plan, and you refi or sell. You know, we're not banking on a sale, but if you can, you do before the end of year 3. And so that's kind of the plan of maximizing NOI to get out of those before the cap expires. If you have to buy a new cap and you can't refi, we have plenty of operational reserves in place, and we've also increased the NOI significantly so that we can kind of account for that. But that's kind of how we model those interest rate caps.
Excellent. What percentage of the overall raise is the Class A preferred?
Yeah, so we're typically budgeting around 5 to 10%. I have to check what it is on this one. I mean, in reality, you know, it depends. It's typically like 3 to 7%, 3 to 10%. It's not a lot. Most investors prefer the upside, and about typically 85% of our investors are in Class B on each deal, and then a small percentage, you know, are Class C. So like, you know, LFI will make up Class C, and then we'll have some individuals, maybe like, I don't know, 3 to 6. Typically, we'll do 500K to $1 million.
Okay. Current economic vacancy seems kind of high. Do you foresee a lot of evictions to turn over the tenant base, and what the current eviction time is in Dallas compared to Arizona?
Yeah, so we talked to like local professionals in the area, and we talked to we also have a local transactional attorney that we engaged for the Dallas market, and he does evictions, you know, every month, and he said that it's very similar to Phoenix. You can evict somebody in 30 to 35 days. So it's really the same type of timeline, very landlord friendly. And yeah, I mean, the economic vacancy, we did a full lease audit, and it actually is a really clean tenant base. And so they've qualified people. I think they were qualifying at 2.5 times the income. We qualify at 3x the income. You know, they had background checks, credit checks. You know, a lot of it is loss to lease. Is a lot of that economic vacancy. And I'd have to go back and look at it. I don't know if you're talking about trailing 12 or pro forma. I mean, we always assume much higher economic vacancy in year 1 and year 2 because we're assuming that we'll have turnover from under renovating units. But yeah, no, we don't have two concerns. I know another question is there any Section 8 or income restricted? The answer is no. There's no Section 8 or waivers at the property, and it's not, you know, it's not like a LIHTC or low income housing. There's no ceilings on the rent, so everything is market rate rental housing, and we don't accept any type of subsidized housing waivers, no Section 8 or anything like that, no home inc. We don't do that in Phoenix either, and so that's kind of what the demographics look like.
And are distributions planned to be paid from the capital raise at any point? Or are they from operations, I think is the question.
Yeah, good question. So typically, depending on the deal, I have to look at this one. Typically in year one, if we're hitting our pro forma and everything seems to be going well, then those operational reserves will start to release a portion of those reserves back to investors through distributions in year one. Because if we're hitting our pro forma and things are going well, then we'll start to release those. So typically it could be 70 to 80% of year one distributions are us releasing some of those operational reserves, which you'll see in that 5-year pro forma. And by the way, when we're doing that, it is not drawing down your capital account. Okay. And so basically we're overcapitalizing the deal on the front end just to have cash buffer, but every monthly distribution that you receive is return on capital, not return of capital. Okay. So like when we sell a deal, we still owe you your entire 50K back plus your profits. In year two, it's typically 100% of your distributions are from like pure quote unquote real cash flow or operational cash flow. And so in year one, we'll start to release some of those reserves back through distributions. 20 to 30% of it is from the cash flow. But it's not all coming from, pure cash flow in year one, because we're going through, we have higher turnover as we're renovating units and going about it that way. But yeah, all your distributions are return on capital and you're not getting your capital account drawn down.
Okay. You've talked a lot about the interest rate cap, but this question is if the cap rate expires and rates are at 9 to 10%, roughly how much will it cost to repurchase something that keeps the property profitable? I assume they mean another cap.
Yeah, good question. I mean, it's tough to say right now because you'd have to see what the cost of caps are at that point. But I mean, I can tell you that right now interest rates are at least 7.5 to 8% or more. And I'll have to look. The cap on this deal is at least 2 to 3 million. So basically, we're raising that money up front as a closing cost, and so you're effectively prepaying the interest. So when you buy that interest rate cap, you're just prepaying it on the front end so that you can ensure it's not going to change for the next 3 years. And so, yeah, it would depend, because the higher interest rates go, the more the higher the caps cost, after that. And so, like to give you an idea, like in 2021, even beginning of 2022, before rates started shooting up, the same cap today that would cost us 50 to 70K could easily cost 1 to 2 million. Because basically you're buying insurance on the interest rate. And so yeah, but right now we're paying 2 to 3 million and interest rates are at least 7.5 to 8% plus for these lenders. So it would kind of depend where interest rates are at the time and where those cap costs are at the time.
Okay. And I'm not sure I completely understand this one, but what are the repercussions if an investor misses a cash call? I assume there are no cash calls, correct?
Correct. Yeah. Good question, Tim. And so in the operating agreement, again, we don't expect to have to do any cash calls. Okay. But if we did do a cash call, you do not have to participate as an investor. It is not required in the subscription docs and the operating agreement. And if we ever do a cash call, then our reputation is basically done, right? Like the company is toast. No one's going to want to invest with a group that did a cash call. It's obviously not a good look on the sponsor. Before we ever got to that point, if we did, which again, we're not in that position, but if we're in the point where like, okay, the company needs an infusion of cash, we as the sponsors, general partners, would first infuse our own personal cash into the deal before we ever asked investors to do it. Okay. And to give you an idea, I've been telling investors this the last few months just to be transparent, because people ask. Between the three of us and the company account, we have over $10 million of personal cash just sitting, not allocated to anything. Okay. So we would first infuse our own cash into deals in order to make sure that there's enough liquidity there before we ever asked an investor. If we ever got to that point where we're infusing our own personal cash, we would send out a disclosure to investors saying, hey, the general partner group is infusing, 500K of cash into the deal, 300K, whatever it needs, for reserves. And we would give investors the opportunity to put in new money if they want, but it's not required. The repercussions, to answer your question, Tim, it's the same repercussions of like any company. So if Jim, if you and I go start a restaurant and we each put in 500K and we own it 50-50, but the restaurant needs more money later. And so you put in an extra 300K and I say, hey, Jim, I don't have any more cash. Well, you have 800K in there now. And so you own more of the deal than I do, more of the company. So I would basically get diluted. Okay. So if there's money infused into the LLC and as an investor, you don't invest an additional pro rata amount, then your ownership percentage would get diluted. You know, it's very minor. Almost every single investor owns less than 1% of the deal. And so this is like a $25 million raise. If we were to infuse 500K, you know, it would slightly dilute each investor by a fraction of a percentage. And that's kind of how any company works. If there's new cash that's put in, it changes the pro rata ownership of everybody.
Okay. Will you be doing a cost seg? And if so, do you have an estimate on how much investors can expect? Percentage, I suppose.
Yeah. Good question, Jesse. So the answer is yes. I will do a full cost segregation study to take full advantage of bonus depreciation. We don't have an estimate. I know a lot of sponsors provide the estimates because the cost seg company will do it. Our first handful of deals, we did that. Like, we'll pay for an estimate from like Madison Specs, or we've used a couple other local ones. And what we found is that it was not very accurate because it's just very speculative. The reality is you're not going to know what the depreciation comes in at until not only the cost seg study is completed, but the K1s are completed. Okay. And so we don't try to give investors like a hard estimate of what it looks like, because we don't think that it's accurate. We don't want to be misleading. As many of you know, this is like the bonus depreciation year one is a Trump tax legislation law, and it's starting to step down, right? So last year was the first year of 100% potential depreciation. This year is still very high. You can get 80% of potential depreciation. In Phoenix, conservatively, we've told investors in the past, and again, I'll give the disclaimer, I'm not a CPA, so consult your CPA. This is not, tax advice. But conservatively, what we've seen is that investors who qualify as a real estate professional in Phoenix could conservatively get 50 to 60% depreciation on the amount that you invest. Okay. Our understanding, I know Robert and Bikron have both invested in several deals passively in Dallas. Okay. I have not, but they have. And we know a bunch of sponsors, and we have a ton of investors that have invested in Dallas deals. And typically Dallas deals or Texas deals have more depreciation than Phoenix in general because of the way that they allocate things to the land versus the property basis. Okay. I don't know all the details, but we've just heard in general, it's a little bit higher. And so it's hard to say, but, I think that if you take 80% of total, and then you were to assume, 50 to 60% of the 80%, then potentially, and again, this is not a projection because I don't know, but I think that if you're investing 100K, I think you could probably conservatively assume you may get 40 to 50K depreciation on that or more. And so that's kind of how that works.
Okay. And how many of your current deals, 27 current deals, are negatively cash flowing today?
Yeah, good question, Kevin. I'd have to check. I don't know off the top of my head, but there's a handful of them. I want to say it's 10 or less. And basically what's happened, and this is happening across, many multifamily deals across the country, is that, in 2021, early 2022, you assume that your debt service is here. You look at where interest rates are going to be going. And so your NOI, you always want it to stay above that, right? And this is kind of what your projections are. Well, what happened is because interest rates went up so quickly, your NOI is here. And within 6 months, even a few months, debt service shoots up all the way to the cap, right? And so you didn't project to increase your NOI that high. The good thing is that we have plenty of operational reserves on those deals to cover that delta. And as we showed in the renovations case study, we're having no issues increasing our rents, increasing NOI. Okay. And so basically we're catching up to that cap where that debt service is at by increasing NOI. And then they will positively cash flow again. If interest rates come down, that obviously helps as well, because the lender adjusts your debt service payment each month. Okay. Depending on where the SOFR index is at. And so I'll email you, Kevin. I don't know. I'm pretty sure it's like 10 or less of the 27. I'll have to check it on the top of my head. But because, like I said, in 2021, because, we bought caps that were a little bit higher because nobody thought you needed to spend so much money to buy a lower cap. And we still had plenty of reserves. We didn't have like a few million of reserves because it didn't seem necessary. We wanted to make sure that we're not burning through reserves. So we paused distributions on 4 of those assets out of the 27. And so that's kind of what the dynamics are of the debt service and reserves and things like that.
All right. Final question. Do you see any other risks to the current macro environment, downside in real estate prices?
Yeah, good question. And so we think that right now is a really good time to buy. Pricing across the country is down 15 to 20% from where it was in Q1 and even first half of Q2 of last year. And it's all because of interest rates. And so, we look at fundamentals like job growth, population growth, demographics are still really strong. The the macro demographic is being pushed into renting properties. And so it's kind of funny because I know a ton of people that have been trying to get into this for like 5 to 7 years. And everybody's been saying the last several years, like, oh, we're at the top of the market. Everything's overheated. I'm going to wait for a recession. Once the recession comes in, I'm going to scoop up everything. Well, now the recession is here. The discounts are right here in front of us. This is a distressed sale. We're getting well below market pricing. And a lot of people are scared because they're like, oh, the interest rates are all over the place. Well, that's where the opportunity is. That's why pricing is down, is because the debt service has gone up. And so, we feel like it's a good time to buy, as long as you can adjust your underwriting to have conservative organic rent growth assumptions, make sure you can execute your business plan, and then you have flexibility with your financing, where you can be able to get out of your loan and refi or sell, and have an interest rate cap. And so I think it depends on the market when you talk about macro components, but that's why we're trying to focus on the biggest markets in the country, like Dallas and Phoenix, we think are both very robust. And many of you have been seeing organic rent growth really plummet across the country. And that's because after COVID, we had this crazy surge of organic rent growth, in all these major cities. And now those have started to normalize. So like when you're looking at trailing 12 organic rent growth, you have to remember that the rent growth has gone up, depending on the market, literally 20 to 40% in the last 3 to 4 years in these major markets. Now it's starting to normalize. And so if you have like even 0 to 10% organic rent growth, and that looks low because, a year ago it was like 15 to 20% organic rent growth, you shot up so quickly in such a short amount of time that you have a higher basis of where that rent growth is. So, you have to just be conservative with what you're expecting. And so, like I said earlier, these hold times are going to be longer. We're not going to be doubling investors' money in 12 to 24 months. We don't think it's realistic. But we do think, 3 to 4 years is realistic. We're projecting 5 years. We think 5 years is realistic as long as you can execute the plan. And so our whole philosophy is maximize NOI right now by renovating the units, executing the business plan. When interest rates come down, which they will, the United States cannot service their own debt for this long. There's over $40 trillion of debt. Treasuries have been over 4%. The entire system will break, okay? And they may not go back down to where they were, but we think in 2024, you will see interest rates come down. When interest rates come down, cap rates will compress. That will drive property values up. At that point, we want to be in a position where our portfolio has very high NOI because we renovated units. And when the interest rates come down, we have high NOI, our values shoot up, and we can sell or refi deals. And so, yeah, we think that we can kind of weather the storm right now with our interest rate caps, with our operational reserves, our ability to renovate units, and then we'll be in good shape. Because I can tell you that I would want to be in Class A. I would not want to be in construction. We aggressively pursued construction, new development in Q4 of 2021, Q1 of 2022. And fortunately, we didn't win any land. I was getting frustrated at the time, but now I'm grateful because I think that's going to get crushed. And we're seeing a lot of those people trickle down into this, affordable space. And so, yeah, that's kind of what we're seeing. And then I know the last question, Jim, is, will you offer a fund this year? And will this property enter it? Maybe a separate Dallas fund? The answer is yes. We've had 2 funds the last 2 years, Rise Fund 1, Rise Fund 2. We're going to launch Rise Fund 3 either the end of January or early February. Rise Fund 3 will be diversified for all the deals that we buy in 2023 across Phoenix and Dallas. Okay, so we want to have a pretty equal balance. In a perfect world, who knows what happens? But in a perfect world, we buy 10 Phoenix deals, 10 Dallas deals this year. And so by investing in the fund, you'll have diversification across those 2 markets, and you'll have higher upfront cash flow and the diversification. It's $100K minimum, accredited investors only, and it's your money won't be liquid for a longer period of time because like we have to close the fund out. So your money is basically in there for like 5 to 6 years until you start getting liquidated. But you're getting that 7 to 8% each year the other duration.
Awesome. Well, thank you so much for spending so much time with us. We really do appreciate it. Just a note for everybody, I will be sending out the recording as soon as I get it done. It will include all of the information about this deal. It will also include 2 soft commit links. So we're hoping to explain this so it doesn't get confusing. If you are going to invest through the tribe, then you just submit your soft commit through the tribe soft commit link, which I will send out. If you are going to invest separately outside of the tribe, just directly with Rise 48, there is another link that is just the Rise 48 soft commit. So under no circumstances should you fill out both commits unless you want to invest both ways. But the typical person will just invest either directly with Rise 48, or they can invest through the Open Tribe. So Zach, if you have anything else to say, otherwise we will close it up and head on our way.
No, that's it. Yeah. Thanks so much, Jim. Thanks everybody. If you have any other questions, of course, email us. You can set up a call with me. Jim, you can relay me questions if people have it, but appreciate your time and look forward to talking to you soon.
Awesome. Thank you so much, Zach. We look forward to working with you, and we'll see you in March 2nd, everybody.
That's
will
right.
be in Phoenix. So thank you very much, everybody.
Thanks, everybody.
Bye.